Hey folks, it's Dave Burrows. I am CEO and CIO, Chief Investment Officer here at Barometer. And I want to welcome everybody to our Tuesday webcast. Boy, it is a beautiful day outside the window today. Nice to have a 24-degree day, and makes me think that summer's coming. It also makes me think that May is coming, and we know there's some seasonality attached to that. Lots going on, lots of news flow coming day by day. Markets seem to be hanging off of every word. And there's a real contradiction, as I put it today, between the hard data, which is backward looking over the last 3 months, and some of the soft data, which is more coincident with what's happening right now. And I think lots of people a little confused by sort of what's going on in the market. And so, as usual, what I'd like to do is just look through our lenses and take a look at what's happening, our stance, how our positions are changing, and talk about how we're sort of managing our way through here. Now, I've said for some time that we're in a structural bull market in stocks, and that sort of continues. We continue above the rising 200-day moving average or 200-week moving average. That's been going on for a long time. And over the course of the month, we've had this big drawdown. And the market certainly got to an oversold level and has seen a bounce. So we traded down through the early part of April, sharply lower. I think at one point we're off about 20%. And market has bounced since then, certainly got to oversold conditions. I've had a few folks ask about the fact that the market has bounced a fair bit. We moved higher, we pulled back a bit, and we're sitting in here right in around resistance, where the market really broke down from in the beginning of April. So just a few things to take away from this chart. Blue line here is the 50-day moving average, which we crossed down over during February. And it has been moving sharply lower. It crossed over the 200-day, as they call it, a death cross, which is a little bit extreme, but market is trading below the 50-day, which is declining. It's trading below the 200-day moving average, which we crossed over in March. Both are in decline. So in the roughest and most simplest terms, the market is in a downtrend. We've had an oversold technical bounce. And it remains to be seen whether this bounce will be successful or not. I have some questions about that. We looked at this data a while ago when the market was down, double digits, what happened going forwards. And some of the occurrences were green through the end of the year. For total return for the year was sort of mixed. So we're working against a bit of a checkered backdrop. When we look at the NASDAQ 100, which is probably more important to look at because it is the most crowded of the indices in the US. It's been the strongest over the last few years, led us on the way up, and frankly, started to weaken, back in June of last year on a relative basis. Said the same picture, crossed down through the 200-day, the 50-day cross down below the 200-day moving average. That signals, a significant change. We traded down through the trend that had been in place since October of 22 when the market made its low. And again, we've had a bounce. But again, is it short covering? Is it a technical bounce? Is it something more? We've talked about the fact that, there's going to be a lot of confusion, I think, in the numbers over the next little while. And we, like to be most aggressive when we have conviction. And there's some times when it's better not to do too much. If I look at the data itself, this is from Goldman Sachs, the hard data, the backwards looking data, the actual data, continues to be pretty good. That being said, we didn't have tariff information really until the 2nd of April. And the soft data, which is more coincident with current market, things like CEO confidence, individual investor confidence, consumer confidence, that type of thing, has definitely been weakening. Certainly, the polls have been showing that Trump has had a significant pullback in support since the election today, 100 days ago. And when we look at some of the other data, consumer confidence has a tendency to move in advance of the unemployment rate. We've certainly seen some consumer confidence data get better. The employment data, getting a little bit worse. This is employment data inverted on the left-hand axis. We're seeing some stuff there. From an earnings perspective, we looked at this last week, where estimates were for first quarter, second quarter, third quarter, and fourth quarter as of October 1st. If we look at it today, it's weaker. If we looked at it last week, the current estimate last week was about $266 in total earnings for the S&P 500 companies. It's lower again this week, 264. And we've seen, earnings revisions pick up to the downside. These are actually the worst net revisions we've seen since 2020. So we shouldn't expect to see companies reporting earnings that are, significantly worse than expected. But the question is, what their guidance is going forward. And we have seen so far lots of companies saying they have less confidence in their guidance going forward, lots of uncertainty, lots of unknowns. Frankly, the news flow is very choppy. And when the market seems to get weak, somebody from because, for instance, if we look at 2022, we had these sell-offs and sharp technical bounces only to go to lower low. Makes a low, rallies, and then retests the low. And in some cases, the weakest securities or the weakest sectors make lower lows. And we haven't seen any of that yet. When we looked at the example of the percentage of stocks trading above their 200-day moving average, this is in 2009, moved down to low levels, we bounce, and then we retest. In 2011-12, we moved to low levels, percent of stocks above the 200 rallied, but then back to test low again. Same thing 2015-16, made a low, stocks rallied above their 200-day and then retested. So I'm not sure that we should expect a V-shaped bottom like we got in 2020, because it's not sort of a binary outcome. We'll wait and see. As we sit right now, bullish percent, or the percent of stocks in uptrends starting in December, worked its way lower to a low of 18%, and we've bounced to 46%. But again, they have a tendency to retest down, up to a lower low. So we'll see. When we look at valuations in the market, we've talked about the fact U.S. market's not cheap. The equity risk premium, the extra return you get owning a company versus owning a bond, is not high. It hasn't been this low since the early part of 2000. We know that U.S. stocks have been significant outperformers versus the rest of the world up until this year. And I think this is really interesting. This is an ETF, SPDW, and it is the MSCI Developed World ex-US ETF, companies from outside of the US. And of course, everything got caught up in the tariff sell-off. But look at this bounce. In this case, this is global stocks above a rising 200-day moving average, above the 50-day moving average, which is also rising, and frankly, right back to highs. And if we look at the long-term picture, we've looked at a lot of these over the last couple of years, where global stocks, after not making any progress, in this case since 2008, are poking their heads up and starting to make new highs. So we started seeing new highs in Japan back in 2022. And even Japan, after a sharp move down, is basically right back to flat on the month of April. India has risen through the month of April. The Euro Stoxx 50 is basically at new highs. And sub countries like Germany, EWG, ETF at new highs. France at new highs. Spain never looked back. And Italy making new highs. So Europe across the board showing relative performance versus the US. Even Argentina, after a sharp sell-off early on, right back toward highs. And the TSX, surprisingly, really just down slightly on the month now and trading back up the moving average above the long-term moving averages. So it's acted a lot like global stocks have. Now, we're not back to highs in the TSX, but certainly we are back above the 200-day moving average. We're back above the 50-day moving average. So I always like to see when a market sells off, first of all, what holds up better than everything else? What is it that investors have conviction about? Second, what is it once the market rallies that shows relative strength, outperformance versus the index itself? And those are the things that we should be focused on. When we look around the world, there's a lot of companies with positive breadth, and we may see some retests, but I would say the global markets look technically sound while the US markets are trading below most of the moving averages. So after a long period of outperformance in US stocks versus the rest of the world, so far on the year, international stocks up 6.5% on average. US stocks down 9.8%. This is as of the 18th. So obviously these have bounced a little since then, but frankly, international stocks have bounced more. When we look at the US dollar has been leading the way lower through the course of the year. So we've seen US stocks underperforming and US dollar underperforming. Probably helps us to understand why, for instance, with a stronger Canadian dollar, some money coming back to the Canadian market, with a stronger Japanese yen and stronger performance in the Japanese market, money going back to Japan, money going back to Europe as euro is strengthening for the first time versus US dollar going back to 2007, and MSCI All World outperforming equal weight S&P. So I would say that this is likely the very beginning. When we think about how large institutions behave, the first thing they may have done as the US dollar has been selling off is to work at hedging the currency risk that they have in their US portfolios. After a decade of money coming to the US for performance, it's going to take some time for committees to decide to de-weight the US market if that's what they decide to do. But they may first want to hedge the currency. I think it's interesting that if you look at the things that have bounced, the one thing that didn't bounce was the US dollar. And that I think is telling. It says to me that US dollar strength is likely to persist. And it may well be that it's actually made a secular shift to a longer term, lower US dollar in periods of, quarters and years, not just corrective. We looked at the fact that a record number of global investors are looking at de-weighting US stocks. And I also find it interesting that the TSX, these are monthly bars, 1, 2, 3, 4, 5, 6, 7 months now outperforming US stock market. So we just take note. And then we look at our holdings to say, does this make sense given the way we're positioned? On fixed income, fixed income yields continue to be quite sticky. Now, as they talk about reducing potentially tariffs on trade deals, that means less revenue that they talked about to help offset the deficit. We'll see how much cutting they're able to get through Congress in the efforts coming from Doge. But my guess is a couple things are different than we've seen in the past. First of all, in 2022, when we started to see economic weakness, Fed started to cut aggressively. You had a pickup in economic activity based on a big surge in immigration. The U.S. administration right now has worked hard to cut off any sorts of immigration, which may not be very stimulative. And if they've got to issue a lot of debt over the course of the year because they've got this big refunding, it's going to be hard to see yields go a lot lower. So let's look at commodity prices. Commodity prices have gone on a march higher. They certainly backed off in the month of April, but they've bounced back toward the highs. We'll see. It's a mixed bag. Some of the more economically sensitive commodities like cotton or iron ore have taken a turn lower. Gold continues to look, pretty darn attractive. Although I will say we, as of last week, got to 70% above the 200-week moving average. And I did highlight over the last while that in the bull market that happened in the 2000s, got to 76% above the 200-week here, got to 80% above the 200-week. I am cognizant of the fact that, eventually we get correction. And so as of last week, we chose to reduce our gold weight because seasonally, if we were to look over the last 5 years from May until sort of the middle of July, there tends to be some seasonal weakness. So we're overbought. We're headed into a seasonally weaker period. Gold has done a remarkable job as a hedge in the portfolio. We just thought it was a good time just to take down our exposure. So in the gold producers, I think we took down by between a third and a half of our position. And in our macro portfolio, actually, we took it down by about a half just to reduce the exposure in the short run. But ultimately, commodities relative to the equally weighted S&P, continue over the last few months to outperform. So commodities, we think, are an asset class that's going to continue to be important. So, we always come back to this point. Our job is to find leadership. Now, we've looked hard over the last few weeks to see if there's any new leadership in the market. As the market's bounced over the last 2-3 weeks, is there something that stands out that has made a change? Because it's our job to find change, and especially at turning points in markets, we want to make sure we stay in tune. Frankly, we felt that it's more important to stay defensive in this case. If you don't have conviction, then you shouldn't be making big new investments. Our job is to be tactical. Now, we're always watching for parts of the market that are showing expanding breadth where more and more securities are participating. And we've seen some of that. However, if we think that there's a good chance that you get a second low and a lower low in some of the weaker securities, and if there's questions around some of the economic data, maybe it makes sense to take our time. You go to the old saying, sell in May and go away. Well, it's April the 29th. So no rush to get this money put to work. Sometimes optionality is pretty important. But we are using our top-down tools to try and make sure we are in parts of the market that are seeing net inflows. We keep going back to our single securities that we own, which is a much smaller number of securities since the beginning of the year. And mind our flock. Make sure that we're taking care of, the assessment, is it time to make an exit? And so we watch our short-term indicators. If we start to see some more weakness in the short-term indicators, you'd see us get sort of more defensive. We've got cash now. We do have a farm team now. We've added a couple of positions, a couple of global positions outside of North America where the setup looks a lot better. We added a little bit in the US, but in more defensive positions, a couple of remarkable positions. We added some Take-Two, which is a video game company, which is just, it's as though there's been nothing going on in the market. It's just charged right along. Our breadth models, continue to be kind of mixed. Let's look at the sector work. The XLF, the financials ETF, continues to be the strongest neighborhood in the market, not just in the US, but globally. If we look at relative strength has continued to work its way higher. So no change in trend here. Obviously, we traded down below the 200, but look at this, pop right back above. And we're very close to going back through the 50-day. When we look at the subgroups, insurance has continued to be a very strong group in our holdings. Fairfax made a new all-time high yesterday. Intact made a new all-time high today. And the European financials have been on fire. This is the last 3 months. We are absolutely at a new high. But again, just the beginning of a new bull market after coming out of a sideways period, going back to sort of to 2008. Banco Santander is one position that we've added. We added it a couple of weeks ago. It made a new all-time high yesterday. I think it was off about 60 basis points today. This is the largest global bank outside of JP Morgan. Just took over leadership from UBS. On the energy side, we're a little cautious here. Energy has bounced nicely from above the long-term moving average, but it's a mixed bag. The gas stocks, companies that are selling natural gas, especially into liquefied natural gas markets, which of course the US is adamant that they want to take share globally. Expand is the largest of the gas producers, the old Chesapeake and Southwest, has marched right back above the moving averages. Relative strength has continued to firm up better than 91% of stocks in the S&P 500. ARC, which is reporting tonight, which I have not seen the numbers on, again, has made a series of higher highs and higher lows in relative strength, and again, quick to move back, not just above the 200-day, the 50-day, the 8-day, and the 21-day moving average. Also pretty darn good. The pipes have been good as a defensive position. They're paying us nice dividends. That's TC Energy and Enbridge. Both have held in really, really well. But let me contrast that against the group of exploration and development companies and service companies in the US, just not performing well. This is the OIH, which is the Oil Services Group. The XOP, which is the ETF that holds the big oil producers, looks very similar. So oil price has been weak, gas price has been strong. We're trying to look beyond the tariffs at what's going to benefit. We think include stay. I think maybe pulled back producers are big cash flow generators. They look tremendous, but they've had a big run. So we did pair our Agnico, we did pair back some of our wheat and precious metals. My guess is we probably see things come back toward the moving averages, which would be, 20 or 25%. We asked ourselves the question, would we be comfortable seeing a 20 or 25% pullback despite staying in an uptrend? And the answer was we should probably reduce some exposure, take some of the money off the table, and be in a position to re-add if they do pull back to support. So nothing to say we think that there is less opportunity going forward, just that if we think there's possibility that the market could pull back in the spring, and if there is seasonality that points to, some risk into summer, better to put a little bit more cash on the sidelines. On industrials also continues to be a really mixed bag. The defense and aerospace stocks, are making relative strength new highs. This has been our focus over the last 18 months. Howmet Aerospace, again, making a new high today. But on the other hand, machinery has shown a very tepid bounce. This is relative strength versus the market. This is what I'm talking about. If you have positions that are not participating in the bounce over the last 2 weeks, you have to ask yourself, what is likely to happen if the market were to weaken? The machinery sector below the long-term moving average really has made lower lows and lower highs. We think there's some risk here, no holdings. Transports, the same picture. They are pretty coincident with what you would expect if the economy were a little weaker. But we take the message from these as being we should be a little cautious with economically sensitive sectors. But this has been going on a while. The transports have been underperforming the S&P 500. And there's an old rule. If the transports aren't performing, you should be a little concerned about the economy. Communication services, Netflix in particular, continues to have good relative strength. Netflix has been our biggest position in the group. It made a new all-time high today, better than 97% of stocks in the S&P. But on the other side, tech continues to be questionable. Again, nice percentage point bounce, but we're below the 50-day, which is declining. We're below the 200-day, which is declining. And if you think about which part of the market is most crowded, tech is most crowded. If you think that when you go and get a retest, you get an undercut of the previous low in the S&P, my guess is there's probably more work to be done here. And when we look at relative strength versus the S&P, it's been weakening for a long time. We're below this breakdown point from last July and from February of this year. This to me looks like a retracement or a technical bounce. We want to be careful. And frankly, if the leader in the group, NVIDIA, can't make a higher high in relative strength, you have to question this as well. So think that there's risk in technology we're avoiding. I think that there's risk in consumer discretionary. It's the same picture here. If I look at what happened in 1997, 98, which was the Asian currency crisis, high beta or high volatility versus low beta made a low at the first low in the market and made a much lower low in the second low. When we look at the same period, consumer discretionary made a low and a much lower low. So it all boils down to kind of where we sit today. Materials is 16%, sorry, was 16% as of last week, which was largely gold positions. It's 15% today, but that's after having taken a significant weight down. Bonds are about the same weight as where we were. I'm sorry. This is financials at 15%. So as of last week, financials were 14%. This week, it's 15%. That reflects an add of some more Santander. Materials are 13% this week. They were 16% last week. That's a taking profits in gold. Continues to be 12%. So between short-term bonds and cash, industrials are about the same. Estate continues to be not there. Technology continues to be 1%. Healthcare is about 2%. Utilities about 2%. And communication services about 2%. So we are continuing to be pretty darn defensive. We look at how things are going on the year for a client who's got a mix of our various mandates. They're off about 2%. I feel pretty good about that. We've had a lot less volatility and we've got a lot of dry powder. And we'll have lots of opportunity, I think, to take advantage of it. The Global Equity Fund, still since inception, is double the return of the MSCI All World Index. And that is the one place that we, sort of continue to add. Last couple of things, indicators of risk. The risk premium that investors are demanding to buy either investment grade or high yield debt, continues to be elevated. Volatility continues to be sort of outside of the range that would be typical during a cyclical bull market. So we're in a correction. We'll see whether it gets worse. We're going to follow the data. We're going to continue to track breadth. We're going to track commentary coming out of this earnings period. And we're going to see what things look like as companies come out of the blackout period. But I think it's really not time to be pushing too hard on things. Certainly after this bounce, there is real risk that, markets retrace. We're above the long-term moving average, so we have to assume that we are still in a structural bull market. But frankly, after 12 years, I would be preferring to put on positions in global markets that have just started a new bull market where valuations are at about a half of US valuations and where, frankly, you can get great representation in the strongest sectors, like companies like Santander. Things get worse, we'll get more defensive. We're going to continue to monitor the situation, so you don't have to. If you've got questions, certainly happy to answer them. But this is an iterative process. And I've had people over the last couple of years say, boy, are you always bullish? And, for quite a while, we have been. But I think that we're looking at risks that we just haven't seen in a long time. And I think it makes sense to pay it. So with that, let's see if Paul is asking, at this time is barometer, is there a move to certain sectors or just go to cash? Great question. So Paul, right now, we would guess that there is between a 40 and 50% chance of a recession. So that's a coin toss. Given the way that transports and machinery and semiconductors are behaving, they are all economically sensitive. They're telling us we should be cautious. You can take money and buy defensive sectors like telecom, say. And we do have a little bit of telecom exposure in AT&T. It's 4.5% dividend. However, those defensive sectors are great for people who have to be invested. If the market were to turn here and race higher because, say, the administration changed their tune on tariffs, it's unlikely that those stocks would lead the market. In fact, they'd probably be seen as a source of funds to go to more economically sensitive sectors. If the market sells off, they will hold up better, but they're not going to be immune to selling. A great example is if you look at the consumer staples sector, which, held up better than the market through the market's decline, but in this bounce actually is selling off. So I think it's not a terrible thing to be in short-term deposits for, a piece of the portfolio. I think on average we're 35 or 40% cash and short-term deposits in portfolios. If I look at where we've been adding, and we've been adding to global because global's in the early stage of a bull market, I think that makes it very attractive. And we can take in more information. I was saying to somebody today, I rarely play client golf, but I can think of all the times I have had a golf game where the market was getting beat up, and I realized that the time I wind up doing that sometimes is May and in June. And seasonally things, are often sloppy in May and June. So, look, we'll see where this goes, but I think that we just take it step by step. Robert is asking a question. What are your thoughts on silver and gold stocks? Seasonality for silver, the same as gold. Yeah, the seasonality into the summer, is not strong, but it's not supportive. And given the fact that we've had just a giant run in these companies, and I was going to put up Barron's put gold on the cover of their newspaper this past weekend. There's an old indicator that says when Barron's is putting it on the front cover, probably it's getting a little overcooked. So look at it. We think that the long-term picture for silver and gold is very, very bullish. So we think that there is a multi-year run in front of us, especially if we are seeing an event where the US dollar is becoming less important to some global investors. Gold becomes a place to go. If they want to own less treasuries, gold is a place to go. So we don't expect a large pullback, but we do think that it should probably consolidate a little bit in here. And we're not selling our whole position. We're selling a part of our position, which gives us an opportunity to add if we get through a consolidation. So not high conviction on the sell, but just I always like to understand what's happened historically in the first leg of a bull market. And this is kind of around where you should expect to see some consolidation. An anonymous asker, feed broke up when we were speaking about tech. I didn't quite catch him by being a crowded market. Okay, so on technology as a sector, it is the sector that everybody in the world came to the US to buy. And the Magnificent Seven, if you want to call them that, have been wonderful, wonderful secular growth stocks. They have been in a massive market. They've grown really nicely. They have performed well, so people have a lot of confidence. But the multiple investors were prepared to pay continued to expand. Now, over the last 6 months, they've been underperforming. So there's probably quite a few people who own these things higher now, and they're underwater. The growth rates clearly are slowing. So when Meta says they're going to scale back their capital spending on data centers, that means something, and Apple's growth is not particularly strong. And certainly Tesla's having their issues. So when the leading group in the market starts to underperform and then have negative performance, it can take some time for that to work its way through the system. And I'm guessing that only a small number of people have really done anything about the fact that these have pulled back, because every time they've pulled back over the last 10 years, people thought, well, here's my chance to buy some more. And I put up last week, and I've got it in here somewhere, I'm sure, the chart of gold versus tech. See if I can find it. Oh, maybe I don't. And the long-term picture, gold has just recently turned up versus technology. And the last time that happened, yeah, I don't have it here, sorry. Last time that happened was in the early part of 2000, and we know that tech underperformed for quite some time. So I think there is at least a real chance that the secular long-term bull market in tech is going to take a breather for a while, and I want to be cautious. It looks like we got one more question from Jim. Sorry, Bob. Bob is asking through listening to me on BNN. Makes him think that William O'Neill was one of the people that influenced me. Care to comment? Yeah, certainly from a stock picking perspective, William O'Neill, I think, had a lot of great rules. And I use the Panarray software, which is William O'Neill software on the stock side. We're big believers that you want to buy companies that not only are doing well, but where something's changing for the better, and you can get a multiple expansion. And so relative strength is important to us versus the group and versus the market. And but we also are big users of Dorsey, Wright and Associates point and figure work. And we've built a strategy that encompasses a lot of different rules to make our decisions. So yeah, I think you always have to learn from the people who came before you. Okay, with that, I'm going to thank everybody for jumping on today. Lots of questions out there. We're going to continue to ask them. We're going to continue to be looking at our portfolio with scrutiny, and we're going to continue to build our farm team because there are some great companies showing up that are really developing on the chart. And I mentioned we added some TTWO, Take Two. We've added some CME Group, which I talked about last week. We own TSX, letter X in Canada, but CME and the CBOE exchange shares are behaving really well, and financial services, continues to be strong. So it's not that there's nothing to do, but I think that we just want to be measured in our approach. Hope everyone has a great week, and I look forward to seeing you again next week at 4 o'clock on Tuesday. Have a great week, everyone.